Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Global stock markets have been pummeled in recent days, but why has fear spread so suddenly? There are plenty of potential culprits, with markets digesting weak economic data, central bank surprises, and sky-high valuations.
I want to know if this is a flash crash or the start of something bigger. And in today's dumb question of the week, should you buy the dip? All right, let's get into it. So just as everyone seemed to be getting comfortable, stock markets have done their best to remind us that they are volatile beasts, haven't they, Roman?
Yeah, a long period of very low volatility kind of lulled people into the expectation that everything was like that all the time, I think. And so this came as a bit of a rude awakening.
Now, I'd like to say we saw this coming because we usually record on Monday mornings, but here we are on Tuesday recording because I think there was a little bit in the back of our minds last week when we saw what was happening in Japan. We thought, maybe Monday is going to be a bloodbath, but I think that's giving ourselves too much credit.
There was a surprise, I think, that Japan had such a big sell-off. Many people thought that this combination of leverage and the carry trade would come unstuck at some point. But look, it's happened now, and I think that's probably a good thing because it's taken some of the potential pitfalls down the line off the table.
Before we get into why this might have happened and what the carry trade is, let's just give a sense of scale. So if you look at the Nikkei 225, which is an index of the Japanese stock market, that fell more than 12% on Monday, which came after an almost 6% fall on Friday, and that is the worst two-day decline in history. And in fact, Monday was almost the record one-day fall for the Japanese stock market. It was only beaten by Black Monday in 1987, which was a 15% fall. Why do these things always happen on Mondays?
Good point. But why do people use the Nikkei index? That's the bigger question for me. It's a price-weighted index. If you use the TOPIX, in fact, this was by far the worst one-day fall on record. So if you go back to 2008, the nearest one was 9.5%. But August the 5th was 12.2% fall. It depends on which index you look at, but I always favour the TOPIX because it's market cap weighted.
But it was a stunning fall, whichever index you look at. Japan had actually been doing pretty well this year, was one of the better performing markets, but then it wiped out all of its year-to-date gains by the end of Monday. But we have seen a bit of a rally as we record this today on Tuesday. I think it's up around 10% for the day, so it's retraced some of its steps.
But it's often the case that you get the best one-day returns after you get the worst falls. So the thing to remember is that if you sell at the first sign of trouble, you could well be locked out of getting all those huge returns, which usually happen on the rebound. And this is why I always put out a video if there is a market pullback saying don't sell, because that's the worst thing people can do.
I saw you put out a very calm, don't panic style video last night, which was well received. It was good. I think it calmed everyone's nerves.
Although some people in the comments did say, are you mad? But it wasn't just Japan that fell, although that was the biggest fall. If you look at the United States, it's been having poor returns for a while. So we've been seeing returns of minus 1%, minus 2%, minus 3% for 3 successive days in August.
And then on Monday, it did fall by 3%, which was the most in a couple of years, actually, since September 2022. But it actually wasn't as bad as I was expecting when we were looking at what had happened in Japan that day, and the futures markets were showing like a 5 or 6% fall in the S&P. So 3% down. Yeah, it's a big move, but it's not crazy.
Yeah, the Nasdaq was down just under 3%. The FTSE 250, the mid-cap index, was down 2.8%. And that came off the back of a 2.9% fall on Friday. So you can see that it was fairly widespread. But in Europe, a fairly sedate fall, 1.4% for the CAC 40, the CAC 40 French index, 1.8% for the DAX on Monday. So, Europe as usual is kind of a safe haven when it comes to exuberance in the US. Unfortunately, that happens on the upside as well as the downside.
I did wonder if everyone was getting a little bit overexcited because on Monday morning there was panic. Like if you looked at Twitter, everyone was like, this is the big one, the crash is coming. But then the S&P is not even in correction territory. It's down less than 10% from its all-time high. Okay, the Nasdaq's down almost 15% as we record this since it's high. But these are pretty normal moves, right? Markets have corrections.
Yeah, and if you come off a valuation which is very high, then there's less support on the downside. So I think that was part of the reason why the US was one of the largest fallers. The UK was already cheap, and so, at a certain point, people step back in. It's only if fear really spreads. And I think the other worry, of course, was geopolitical instability and whether that was about to kick off. And of course, these things often come in clusters. You have some bad news and then it's compounded by something else happening. So I was worried that that would happen. But still, for the time being, let's keep our fingers crossed that hasn't happened.
But if we're putting it in historical context, the S&P being down almost 10% is not really remarkable. So there's some stats here that for the S&P 500 since 1928, in almost 2/3 of years, it has a peak to trough drawdown of 10% or worse. So it's actually more rare that it doesn't have a correction within a calendar year.
Yeah, small falls happen all the time. And I've got a rule which is the 2-6-16 rule, which looks at the returns over an entire year. And there you can see that if there's a 30% or greater fall, the probability is 2%. So very low for a really big fall. For a 20% fall, it's 6%. For a 10% fall, it's 16%. They happen all the time.
Doesn't stop people panicking so much though, does it? Like I saw that on August the 2nd, Jim Cramer tweeted that NASDAQ futures dropping as if it's the end of the world. Memo to all, it isn't. Now, that did actually panic me, because if Jim Cramer says it's not the end of the world. I mean, people do look for these little omens, don't they? Like, a lot of people noted that Warren Buffett had sold a lot of stock over the last quarter. In fact, he'd halved his Apple stake, which was his biggest holding, and has a record amount of cash on the Berkshire Hathaway balance sheet. $277 billion of cash and T-bills. That's a lot of dry powder if Buffett decides to start buying.
Yeah, valuations at the moment in the US are just not very compelling. So I think even now, even after the sell-off, that's still the case. If you look at US valuations, it's still at a pretty high multiple. So I think, the attractiveness, the bargains are just not there. And I was looking at my market crash shopping list, and really there isn't much which has come down a lot in terms of the stuff I want to buy. So this is really a very poor crash indeed. It doesn't make valuations really cheap, and the stuff I want to buy is still pretty expensive.
So it's unremarkable from that point of view in terms of the sheer scale of the stock pullback. But it is quite a remarkable mini crash in terms of volatility. So the VIX index, which people kind of think of as the fear gauge for the S&P 500, that spiked massively and actually reached a level of over 65, which, to put it in context, means only the 2008 financial crisis and the start of COVID saw bigger peaks in the fear gauge.
Yeah, the way that's worked out is you take a giant out-of-the-money portfolio of options for the S&P 500, for stocks in the S&P 500, and munge together their prices, and it comes up with an implied volatility for the S&P 500 as a whole, based on those options prices. And yeah, it's spiked to above 60%. There have only been 3 comparable spikes like that, so it really was shocking. Although as we record this, it's fallen back to 34. So it was fairly short-lived. Sometimes VIX spikes and it stays high. But that wasn't the case, at least not so far.
So a high peak of panic that quickly subsided. But I guess the question is, what caused this panic in markets? What caused Japan to have its record one-day fall and VIX to go crazy?
Personally, I think the biggest shock in terms of macroeconomic data was the US employment numbers. And that was pretty shocking because, as I said in this video that I did, what happened previously was that the Federal Reserve had pretty much painted a rosy picture of a US economy that was just kind of normalizing. Supply and demand for labor was coming back into sync. Demand was still reasonably high from consumers. Jerome Powell kept on quoting this number, the PDFP number, which is private domestic final purchases, which is really just looking at private domestic consumers to see whether they're still buying stuff. And they were. That was still okay. Wage growth was still pretty strong. Unemployment was rising. but it was still at quite low levels compared to history. So all of that was a fairly benign picture, soft landing picture, which he painted.
And I remember your live stream response video where you described Jerome Powell as sort of taking a lap of the room and celebrating the soft landing in his sort of understated way. But then the shock came, didn't it, in the jobs numbers?
Yeah, bam. We got the numbers and it was pretty bad. It wasn't atrocious, but it triggered the SARM rule, which got a lot of attention. Claudia Sarm's actually come out and said, look, this recession indicator I've come up with, I think this is a false positive. The US is not in recession. And since the numbers came out, Fed representatives have come out and said, no, the US is not in recession. And it isn't. It's very unlikely to be.
It's not up to them, though, is it? It's up to some other weird, unaccountable body. Who calls the recession in the US again?
It's the NBER committee. But look, the point is that the overall picture is not one which is really bad. And part of the reason why unemployment's gone up is because more people have entered the jobs market. The participation rate's gone up and there have been lots of immigrants in the US. So I don't think the market interpretation, which is a catastrophe, is a good one.
It did seem a small move, didn't it? So the unemployment rate rose from 4.1% to 4.3%. A couple of tenths of a percentage point move. But like you say, it triggered the SARM rule, which historically has meant we're in recession now. There's been no false positives. So this might be the first one if we don't get a recession. Like you can never be sure, right?
Yep, economics can't forecast the present or even the past, which is incredible.
I saw someone on Twitter with one of the best wisecracks I've seen in this whole episode, which said, SARM rules are meant to be broken.
Oh, I love that one.
But the point you make about the participation rate is interesting. So a big chunk of this rise in unemployment is literally the fact that more people on the survey said, yeah, I'm looking for a job now and I don't have one yet, which means that the percentage of unemployment is higher.
Yeah, more people in the jobs market. It depends on the definition you look at. U3 is the one people usually use. U6 is broader in terms of the number of people it includes. But yeah, participation rate is one of the things Powell actually mentioned as driving the higher unemployment numbers. And he also came up with a real nice nugget, nice soundbite, which is we're data dependent, not data point dependent, which I think sums it up nicely. They look at the whole picture. They don't just look at one number like unemployment.
Can I throw a few more data points at you then to maybe give some hint that the economy is slowing down? So the ISM manufacturing PMI, which is kind of a temperature gauge of activity at factories, that came in at 46.8, and anything below 50 signals contraction. And there's been a lot of contraction over the months, but this is a particularly bad reading. We've also seen on earnings report from some prominent retailers like McDonald's and Starbucks, who obviously serve huge parts of the American economy. They've warned explicitly about struggling consumers and said, this is why our sales are falling on a same store basis. So it's not just the unemployment rate going up and a weak jobs number. There are some sort of anecdotal, more forward-looking things which don't look great.
But this is what you'd expect. In fact, what you'd probably expect is a full-on recession if the Fed's whacked up interest rates 5 percentage points, and yet all you're getting is a cooling off of the economy. Well, the cooling off is part of the design, right? That's what they want, less demand. So it's really a difficult balancing act from the Fed's point of view, but it did look like they pulled it off. But maybe things aren't so good. And the thing to remember is that they've got huge firepower now, because if the labour market does weaken, they've got 5 percentage points of cuts in the bag in order to stabilise the economy and to get things going again. So I think that's why I'm not getting too worried at this point. Earnings are kind of holding up in the United States for companies. The economy's weakening, but not crashing. And the Fed's got huge firepower if the labour market does weaken. So I think there is a backstop there. The Fed put's still in place.
Yeah, this whole term of weakening seems to be overselling it to me. It's normalizing, really. We've had a hot economy, strong wage growth, really strong jobs numbers, so many months over 200,000 jobs added. And now people are panicking at 114,000 jobs. We used to say 100,000 jobs is the neutral rate, and we're still above that.
But what's been remarkable is how strong markets have been, equity markets in the US, to all of this huge tightening of monetary policy. Usually that's a recipe for a big sell-off, but not in this case. And I think people are still of the mindset that the stock market is almost untouchable. So hopefully this took some of that narrative out of the picture, because I think it's unhealthy. I think valuations for some of these stocks are just unrealistic.
The S&P 500 seems to have been bouncing around a forward price to earnings ratio of around 20, give or take, for much of the last couple of years.
Yeah, and that's unusually high. Not crazily high, but pretty high. And, something like 17 times would be more normal. That would be fair value, maybe 16 times if you look back further. So what it would take would be a 10% fall in the S&P from where we are now as we record this to get us to roughly fair value.
We do keep having to say as we record this just because volatility is crazy high right now. So let's hope all of this stuff is relevant by the time you listen to this.
But that would be about 4,600 for the S&P, just to put a number on it.
But just to go back to the broad economy in America, are we going to get a recession? The Federal Reserve Bank of Atlanta publishes a GDP now figure, which is their best guess at what GDP will come in at for the next quarter. And it has actually been surprisingly accurate recently. And they're forecasting 2.5% growth as of last week, which, is a long way from recession if we're talking about recession as being an economic contraction.
Yeah, I just can't see it. I just can't see the US going to recession from where we are now. But, eventually it will, but I just don't think we're there yet. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. If you trade US stocks, then 24/5 trading gives you non-stop market access from Monday until Friday via more trading sessions, while still using Trading 212's fractional shares and zero commission trading. You can also switch between 24/5 and regular hours orders at any time. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. Terms and fees apply.
So the economic situation in the US and the potential weakening of growth is only one part of the puzzle here, really. It doesn't answer why the Japanese stock market and Asian stock markets in particular had such a severe and sudden fall. Now, a lot of people are pointing the finger at the Bank of Japan and the unwinding of what's called the carry trade. It's a bit of a niche thing, even though it is widespread. Is there a way we can explain this that isn't going to blow everyone's minds?
Well, I think it's fundamentally simple, which is you borrow money where it's cheap and invest it where it's got a higher rate. That's the gist of it. There are some derivatives thrown in usually by hedge funds, but that's how it works. So if you look at Japan, it's been very much at odds with the rest of the world. It's had zero interest rates for ages, at the same time that all the other central banks were whacking up interest rates like nobody's business. That meant that you could borrow in yen very cheaply, sell that yen, and then invest it where rates are high, which would be places like Mexico, where the policy rate's above 11%. And then you lock in the currency rate using something called a currency forward. So as long as volatility is not too high, then those currency forwards are pretty reasonable. But of course, this is a leverage trade. You're borrowing money to invest it. So what goes wrong is that the currency forwards become very expensive. You get margin calls. And if the volatility of the currency picks up, that's what causes it to unwind.
I love the fact you said this is all very simple. And then you sort of said currency forwards, leverage, unwind. But the basic point is people went to Japan, borrowed cheap money, and used that cheap money to buy stuff where they could get a really good return. Might have been abroad, might even have just been the domestic Japanese stock market, right? And then what happened? The Bank of Japan did the unthinkable and started to raise interest rates. Now, they raised it a tiny amount. So back in March, they raised it 10 basis points, which is 0.1%. And then last week, they raised it another 15 basis points. So in total, 25 basis points of rate hikes, kind of nothing. But when you've been used to negative interest rates, that molehill turns into a mountain and reverses this huge carry trade.
That's right. And the currency instability that came with it, that's what caused the margin calls. And that meant that hedge funds had to close the trades out. That meant they had to get cash. And it's probably easier to sell other stuff, which is more liquid, than to unwind the trade itself. So they could have sold Japanese stocks, for example, in order to get the yen to pay their margin. So that's how it kind of spills from one market into another. That's a classic volatility spillage from one trade to another.
And it's presumably the prime culprit for why Japanese stocks had such a big tumble.
Yeah, I mean, it's kind of like honey for bears, right? If you have a big pool of honey, it's going to attract Winnie the Pooh. And if you've got a huge interest rate differential, what hedge fund wouldn't want to have a go, at least? An 11% differential in rates is amazing. But of course, it comes with risks.
Yeah, and to me, what made it particularly stark was the shift in opposite directions from the Fed and the Bank of Japan. So we said the Fed held rates, which they did. But following that weak jobs data in the US, the market decided the Fed had maybe made a mistake and would have to play catch up and said, okay, next meeting in September, the Fed is going to cut by 50 basis points. So a very sudden drop in short-term yields. Whereas the Bank of Japan going in the opposite direction, hiking rates, again, unexpectedly, it wasn't expected to hike rates. That's a big differential going in both directions, right? And therefore, the yen strengthened massively.
And this is why I think volatility, if you think of it as information flow, I think it's a really useful way of seeing it. Because what happened was surprising. And when something surprising happens, information flows. Things get repriced and prices move rapidly. So volatility is just the sound of the market digesting this new information. Unfortunately, that digestive process also took out some hedge funds.
Yeah. We came into this with a concentrated market, right? In many different respects. We've said over the past year how concentrated, for example, the US stock market is in a handful of companies. And I think we have to say there's been crowded trades. So the long Magnificent Seven trade, incredibly concentrated. But also, everyone's been piling into short the yen and short volatility. And now all those three things seem to be unwinding at the same time.
And that's often the way. You get these shocks and then everything unwinds in one go. And it's often the case that one market, one unwind, spills over into others. So at least for now, it seems as if the really bad move, the large negative move, was Japan. For the US, it's just a slow devaluation with lots of lousy returns. And for Europe, again, a fairly sedate fall. But these things can happen slowly, then quickly.
Yeah, I guess you have to hope there isn't some crazy interlinkage, which no one's really spotted yet, where, like you say, a hedge fund blows up or a bank blows up, something which is unexpected, which then triggers the cascade. But if things stay contained, then hopefully this would be a short-term bout of volatility.
Yeah, it's looking that way. And then if you add geopolitics on top, if something bad happens in the Middle East, then maybe that could trigger another episode. But let's hope that there aren't pockets of leverage hidden somewhere that suddenly come to light, or finance scandals, accounting scandals, which often come to light as well.
The Middle East is an interesting one. At the moment, I don't think that's what's driving the nervousness, simply because the price of oil is not going up. Like if it was a panic about the Middle East, you'd expect oil to be appreciating.
Yeah, and in fact, Andrew Bailey cursed this by mentioning it. And he said, usually what you see if you have unrest in the Middle East is that oil prices spike. And that's why the Bank of England had an upside skew on their inflation forecast. But they actually changed that. They took it away. and replaced the skew with another one, which was higher domestic inflation worries.
They didn't want to completely remove the skew, did they? In case things do go bad on the upside.
That's right. They always want to cover themselves. But you're right, this is unusual to have Middle East turmoil without energy prices spiking, without oil prices spiking.
It seems to me that the Middle East is a worry, but the markets have not got there yet. They're worried about other stuff first. And the prime worry is probably central bank policy. And is it going to keep surprising us? So I wanted to come back to the Fed, actually, because a lot of people are saying, well, the Fed made a mistake. High-profile commentators have said this, like Mohamed Al-Arian, Paul Krugman, the usual suspects. Do you think the Fed made a mistake? Should it have cut last week?
No, I don't think they should. They always operate based on what they see at the time of the meeting. And at the time of the meeting, they didn't see a huge pickup in unemployment. 7/10 was the way Powell described it, and still pretty low levels. At the next meeting, clearly, September, they're going to see things in a different light. And I think they were teeing up a September cut anyway. So it's just a question of how big the cut's going to be. Is it going to be 50 basis points? And I'd be surprised if it was. But it really depends on whether the unemployment data is corroborated by other data points.
As we record this, the market says there's a 75% chance it's going to be the bigger cut, the 50 basis point cut.
And they don't usually surprise. They usually do what markets expect. I'm sure it's not guided by what the markets expect, but
sure.
In this case, they just look at that table and say, oh, 2 cuts.
Yeah. But they do say they're in the business of trying to discover what the correct rate is rather than just setting a rate, don't they? And the market's presumably trying to discover what the rate is as well. They're both feeling their way in the dark to some degree.
Yeah, and their point, which was a good one, is that if you look at services inflation in the United States, it hasn't come down as much. So you can kind of understand their reluctance to cut rates. You can see why it was a unanimous decision. And if it had got some element of doubt, I don't think it would have been unanimous. So clearly, based on the data laid out to them, they thought that was the right thing to do. And I kind of agree with them.
I guess I think that if they had have cut last week, markets would have taken that as a sign that the Fed was really worried and would have probably done exactly what they've done in the last. I don't think it would have stopped this panic. If anything, it might have amplified it. And some people have said, should the Fed now come in with an emergency rate cut before the next meeting? This sell-off is so severe, volatility so bad, the economy is going to go into recession, the Fed needs to move now. And in fact, at one point on Monday, markets were pricing in a 60% chance of an emergency rate cut within the next week. Those odds have since fallen back as people realize Jerome Powell is not one for panicking. And I guess there's the possibility that were the Fed to accelerate its rate cuts, it could make the problem worse for the simple fact that the differential with the Bank of Japan gets bigger and therefore reinforces the strength of the yen, and this whole carry trade unwind just accelerates.
Yeah, strictly speaking, they don't do that. If you ask them outright, they say, oh no, we don't consider other countries. We're aware of their problems because, of course, they talk to each other all the time. UAID is going to be talking to Powell all the time, particularly at the moment with this crisis. But they can't operate policy based on what's happening globally. Now, strictly speaking, that's true. But if you actually look at the best predictor of what the Fed does, yeah, it's a stock market.
But we're not going to get an emergency rate cut, are we?
No, I think it signals absolutely the wrong thing. A 25 basis point cut has almost no significant impact in real terms for the economy. Its effect is psychological, particularly the first one. Then the second one's not so impactful usually, and the third one even less so. So I think it's really about psychology here, and the Fed signalling that, yep, the labour market's weakening. Our mandate, our dual mandate, is shifting more towards unemployment now. Previously, it was all about inflation. And we're going to do something about this weakening economy.
Despite the fact that the Fed has held steady and not moved, yields have fallen sharply, haven't they? Which means that, at least in this instance, bonds are back to doing what we know and love and hedging stock market falls.
Yeah, I was just looking at the gilt yield curve this morning, and the entire yield curve has shifted down. So if you'd have gone for one of those long duration UK gilts, they would have provided the hedge you needed. They lost their gains almost immediately after a day, but they did do what they're supposed to, which is to hedge equity.
I mean, I hope that the soft landing narrative is still possible. It's still the central case. And this is just turbulence as we approach the runway.
Yeah, I think that's the case. If you look at the global economy, it's just not in that bad shape. So I don't think there's going to be a huge sustained sell-off. I mean, some people were talking about another 10-year market correction where it's going to take ages to recover. I just don't see that.
And like you said earlier, if we had another 10% fall from here, that would be kind of normal and would just take us back to the 10-year average, right?
Yeah, and that would probably be healthy because most people are in the situation where they're still putting money into their savings. And if that's the case, it just means you buy at a cheaper price and that increases your long-term return usually. So that's a positive, I think. If you're in retirement, clearly it's a problem because you haven't got so much money. But always it's good to work out what the best asset allocation is during good times and get an equity allocation that you're comfortable with before the crash happens. I always say this, and of course it's always too late by the time people listen.
Yeah, the best time to sort out your asset allocation is when markets are at all-time highs, I would suggest.
So really, I think it's a matter of sticking to your plan, whatever your plan is, and building crashes into the plan because they happen. This reminded us of that. And keeping calm. Don't do anything in a panic when you're scared because that usually leads to bad decisions and losses.
And I think in this instance in particular, there's no need to panic. Like zoom out on the graph, the S&P 500 is up around 10% year to date. This is not a market crash, at least not yet. And like you said earlier, earnings growth is strong. We're currently in the middle of the Q2 earnings season, and it looks like it's going to come in at around 11 or 12% year-on-year growth. Perfectly reasonable. In fact, the best rate since Q4 2021. And analysts are not cutting their forecasts for future quarters in any significant way. They're forecasting a growth rate of 6.1% for Q3 and 16.1% for Q4 in America. This is not a situation where there's an earnings recession or US companies, which remember form most of your global index, they're not particularly struggling in the aggregate.
That's right. So I don't think it's really a time to panic because there is that backdrop of economic data, but also fundamental data for companies, which is supporting markets. So even if they fall, buyers will step in. It's when there's an earnings recession that you really have to start worrying because then you take away the safety net. And if things fall, they can carry on falling.
So I suppose if we're looking for reasons why this might unexpectedly get a lot worse, like we've got to do it right. We've got to give the panickers some sort of meat. Like, what would it be? It would be that global growth disappoints and we do get a recession, earnings fall, or there's a big financial accident brewing somewhere because of leverage.
Or a geopolitical accident. I think that's another possibility. And it's not just about war. It's about protectionism and stifling global trade with protectionist measures, these kind of trade wars that often ensue on the back of it. So I think a lot of that would hurt earnings, it would hurt growth, and it's actually looking quite likely that we are going down that path. So that's probably more damaging in some ways than some kind of conflict.
I think markets would really hate a disputed US election. Like if it all ended up at the Supreme Court, people refusing to accept the election results and all of that, I think that would be bad.
So I think those are the most immediate risks, the ones which are pretty obvious. But volatility is often auto-correlated. It stays high when it's been triggered. It's kind of like ringing a bell. It carries on ringing for some time, even after you've struck it. So I'd expect to have a choppy couple of weeks at least following this event.
Yeah, and don't get mad at us if there is a big market crash because no one can predict these things.
And I think it's always useful to have people you can talk to when these scary things happen in order to keep you on track. And our community has a chat application just for that. And if you want to join us and maybe join that conversation, you can do that on our website, PensionCraft.com/membership.
Okay, today's dumb question of the week is, should you buy the dip? There is a dip. Should you buy it?
Well, there's not much of a dip, to be fair. And I think that's the problem. That's why when I was looking through my market crash shopping list, I just didn't see anything compelling. There are certain things I like copper companies. Copper prices are still falling, and the share prices haven't fallen that much. So, that's not attractive. Scottish Mortgage, which I've already bought, has fallen a lot. So, unfortunately, I already own that. I'm not sure I want to increase my weighting.
But this is your fund portfolio, right?
Yeah, this is just for tactical stuff where I lose money.
Presumably, you're fully invested in your core portfolio, because the drawback of this buy the dip mentality is that it does necessitate you having dry powder, as in having some cash or other safe assets, which you then plow into the market on the dip.
Well, weirdly, I do have quite a lot of dry powder because I created an ISA. I opened an ISA so I could trade bonds just to try them out. And after those matured, I just put it into CSH2, a money market fund. So I've got 20K there. And it turns out I've got half of my fund portfolio also in CSH2. So I've actually got a lot of dry powder at the moment. I call it my fund portfolio, but it's actually quite safe. But I just can't see anywhere compelling to deploy it. I can see why Warren Buffett's holding back at this point. He's not buying lots of stuff because things still aren't cheap.
Yeah, Buffett is one of the most patient men on earth, right? He can just sit there with a huge amount of cash for a long time. Or in this case, T-bills, and he's getting paid 5% on them. I read that he actually has more T-bills. This is short-dated US government debt. He has more T-bills than the Federal Reserve. He's the biggest holder in the world.
That doesn't surprise me. The scale of everything he does is by definition large. It has to be.
Because the Fed has a massive balance sheet, but a lot of it is in longer duration debt.
But even in the UK, if you've got a money market fund, even after the rate cut, you're probably still earning about 5%. So that's pretty good for being in a very safe asset. So I'm happy to wait. The carry's good if you're in cash, and it's positive in real terms. So patience pays at the moment.
And can I just broaden this question a bit more? So should you buy the dip? In this specific example in your fund portfolio, you're saying you don't see anything that compelling. So you're prepared to wait in cash and get paid to hold it. But just more generally, when you talk about the core portfolio and should you buy the dip and hold cash back from the market, generally, I think that's a bad idea. I saw some good research from Nick Majuli, who runs Of Dollars and Data, where he looked at the buy the dip kind of strategy, where you hold money back until there's a significant market correction, then you pile it all in, and then you just wait again for there's another big correction, then you pile in what you've accumulated then. So that strategy, buy the dip versus just dollar cost averaging, just putting money into the market regularly every month, ignoring what the market's doing. And generally, putting money into the market as soon as you get it, this dollar cost averaging approach, is the best way to invest. That's not to say the buy the dip strategy can never win. It's just that when it wins, it might win by a little bit, but when it loses by a lot. And that's because you might be waiting a long time for a dip. And without dips, you just end up holding cash for a long time, which is a terrible long-term investment strategy.
Yeah, I did a similar analysis. I used the excess cape yield, Robert Shiller's measure of expensiveness and cheapness. And the way I did it was to say every month you either put $1 into the equity market or you put it into cash and then let the cash accumulate at the cash rate. And then when valuations get cheap enough, you go all in on the stock market with your built-up buffer of cash. And there was no threshold for cheapness where that strategy consistently outperformed. Like you say, there were certain periods when it did by a bit, but they were unusual. So I really just don't think holding money back from the market works because valuation doesn't tell you when the crashes are going to happen.
And yet, if you hold a portfolio split between stocks and bonds and you rebalance, maybe annually, you do get a rebalancing bonus. It does seem to help risk-adjusted returns if you have two assets which are not positively correlated. And then when one rises and one falls, you sell the one that's gone up and buy the one that's gone down, bringing them back into your desired asset allocation. That does seem to be a good thing.
Yep, usually that works. Of course, the problem is that the safe thing will underperform long term. So you have to kind of trade that off against the rebalancing benefits.
Yeah, it's one of those weird situations where it hurts your sort of absolute long-term returns, but improves your risk-adjusted returns.
So you'd sleep better. You'd have a less stressful life if you do that.
Or you lever it up to match the volatility of the crash your asset and you would outperform theoretically.
Yeah, that's an interesting approach. And I think that might be an interesting one to talk about in future. So I think for some people, if they are early in their investment career, there will be lots of these crashes over the course of their life. And really, it should be an opportunity to pile in and buy the cheap stuff if you've got spare cash. But don't hold money back from markets if there isn't a crash, because that would be catastrophic.
It's also just a weird thing psychologically to design your plan based around what the market might do, because you can't control what the market does.
Or basing it on a rare event, which is kind of silly because you could be waiting a very long time.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.